Okay, so welcome to the second video of Chapter 5. We're going to now journalize and post our closing entries. So closing entries are a way for us to zero out our temporary accounts. So we have temporary accounts and we have permanent accounts. Every account that appears on the balance sheet is a permanent account. So remember, this would include all assets, all liabilities, and then capital. It would not include anything that does not appear on the balance sheet. So that means our temporary accounts would include our revenues and our expenses that appear on the income statement, and then those withdrawal accounts that appear only on the statement of owner's equity. So those temporary accounts, they need to be zeroed out so that I can start over the next year or the next period with a zero balance in them, so that I can start counting how much profit did I make this year. So if I want to count profit that I made this year, I need to start over at zero and count up from zero. So all of those accounts need to be zeroed out. So recall our expanded accounting equation. Remember, we said assets are equal to liabilities plus equity. So our equity accounts were capital minus withdrawals plus revenue minus expenses, right? So I kind of preferred to write it like this. Assets are equal to liabilities plus owner's equity, where owner's equity is equal to capital, and capital is net income minus the withdrawals, and then net income is revenue minus expenses. So when we write it this way, we can see that everything that needs to go into the capital account needs to be closed out. So all of this stuff, everything that I need that I'm ultimately going to put into the capital account, needs to be closed out or zeroed out. So liabilities, assets, and capital, these accounts here are what we call our permanent accounts. They are on the balance sheet and those balances carry over. So withdrawals, expenses, and revenues, we call those temporary accounts, or you may hear them called nominal accounts. They have to be zeroed out at the end of every period. So there's 4 steps to zero out our accounts. Number 1, we need to zero out the revenue balance. Now let's think about this for a minute. I'm going to write aid reveille or all reveille if you prefer up here at the top. Now revenue has a normal credit balance. So if I want to decrease it to 0, then what should I do to it? You're right, I need to debit revenue. So I want to zero out revenue by debiting revenue. And then I'm going to transfer it to this new account that we're just introduced to called income summary. We only use income summary during closing entries, so we're going to use it 3 times and that's it. So remember, we've said that we always credit revenue, except for that one time a year. This is that one time a year. This is the only time that I'm actually going to debit a revenue account. So then I need to zero out all of my individual expense accounts. Now remember, expenses have a normal debit balance. So to zero them out, to decrease them to 0, what should I do to them? You're right, I want to credit them. So I'm going to credit these expense accounts and then I'll debit that income summary account. So then I need to close out income summary, and I'm going to close it out to capital, and then I have to close out withdrawals. Now remember, we don't always have withdrawals. Sometimes the owner doesn't withdraw money. So if the owner doesn't withdraw money, then guess what? We just don't have to do step 4. But if they do, we need to close withdrawals. So withdrawals are drawing, remember, has a normal debit balance. So to decrease it to 0, I will need to credit it just like I do expenses. Now notice that withdrawals do not get credited to income summary. Withdrawals go straight into the capital account. So again, this is just a diagram to kind of help us process this. Revenues get closed to income summary, expenses get closed to income summary gets closed to capital, and then withdrawals also get closed to capital. So when I'm looking at my income statement columns of the balance sheet, these are all, of the worksheet, these are all the accounts I'm going to close, as well as that withdrawals column in the balance sheet, which remember isn't really in the balance sheet. I just use it in the balance sheet column of the worksheet because I don't have columns for the statement of owner's equity. So when I looked at that column, I saw that revenues had our graphic design fees, which is our revenue account, has a credit balance of $8,000. So that means to close it out, to zero it out, I would want to debit graphic design fees of $8,000, which means I have to credit income summary. So I'm going to this is my graphic design fees. I'm now going to debit it for $8,000, which makes it be zero, and income summary now has a credit balance of $8,000. So I'm going to write the closing entry where I've debited graphic design fees, credited income summary. Now my expenses, notice that my expenses all have debit balances. So to close them out, remember I'm going to have to credit each one of them individually, and I'm going to then debit income summary for the total. So the total of those expenses is $3,100 that's I've debited to income summary, and notice I've credited each expense individually. You can't just say expenses and credit it for the total. You got to credit each one individually. And now that I've posted those, now all of my expense accounts have a zero balance, but pay special attention down here to income summary. It had a credit of $8,000 for the revenue and now a debit of $3,100 for the expenses. So what's the new balance in income summary? If we were to draw this out, my new balance in income summary would be $4,900, and it would go on the credit side because remember we put the balance on the largest side. Now if you remember back, $4,900 was the amount of my net income. So this is my net income on the credit side of income summary. So now I need to close income summary. So if you remember from our previous slide, income summary has a credit balance of $4,900. So to zero out income summary, I would want to debit income summary. So income summary has a credit balance of $4,900. So I'm going to now debit it, and I will then credit capital. Now remember, capital has a normal credit balance. So when I credit capital, I'm actually increasing the capital account, which is what net income should do, right? It should increase the capital account. Sorry, I changed slides in the middle of that, so I think that cut me off. So when I debit income summary, now income summary is zeroed out, but capital, notice, has a credit. Capital has a normal credit balance. So when I credit capital, I am increasing it, which is what net income should do. Net income should make capital go up. It should be larger now. Now the last thing I need to do is to close withdrawals. So remember, withdrawals has a $625 debit balance. So to close it, I would want to credit it. So if I'm crediting withdrawals, then I have to debit capital. So when I debit capital, I'm actually decreasing the capital account because remember, capital has a normal credit balance. But it makes sense because withdrawals decrease our capital account. So here's just a summary of all of the journal entries, the closing entries that we've closed out. Now remember, we may or may not have this fourth one depending on if we had withdrawals. And here are the ledgers where I've actually posted all of these. So here we can see these accounts, cash, we didn't adjust, accounts receivable, computer supplies. We've got all of our ledger accounts here. We'll notice that withdrawals here has a zero balance now. Notice income summary has a zero balance. Graphic design fees has a zero balance. Office salary expense is zero. Advertising expenses zero. Here, my telephone expense is 0, computer supplies expense is 0, rent expense is 0, depreciation expense is 0. And now I've closed out all of my temporary accounts.